Welcome to Market Movers. I'm Jim Urio with Scott Martin.
Hi, Jim.
Okay, so on the 30th, we have another Fed meeting. The CME FedWatch tool says there's a 90% chance that they ease. If they weren't going to ease, wouldn't they have let us know by now?
Jim, this is the U.S. Federal Reserve we're talking about, my friend. Communication has not been their strong suit. I do believe they're getting better in the communication department, maybe taking some education there. So I agree with you. Yes, we would probably, I think, know by now, or the markets would, let's say, per that tool you mentioned, that they were not going to ease if they weren't going to do it.
This is an important question. Is this ease actually needed, or are they just doing it because the market's forcing them?
Well, it's needed in the sense that the market's telling them to do it still, I believe. Yes, the curve is steepened out a bit. We're not in the inversion that we were anymore, but certainly the data still allows them, at least the data has provided that lead block that allows them to push one more rate ease in.
Before we dive into our trade discussion, I'd like to point out that these are examples, not recommendations or advice. Scott.
Yeah, Jim. So talking about the easing that we think is coming up, the easier moves maybe that we're going to see from the Fed just at least later this month and soon, makes me believe that rates have maybe overreacted somewhat to the upside, meaning prices have fallen in response or in, say, reflection of what's coming up from the Fed. So today, Jim, as an example, just looking at the charts, looking at some levels, I found something interesting. Specifically, Jim, looking at the October 30th in the 10-year, the 130, 131 call spread for 16 ticks. This trade risks $250 to put on to make a potential $750. It expires October 30th, as I mentioned, so it gets you through the Fed meeting. It does not get you through non-farm payroll, but gets you through the end of the month. The underlying was 129.25, and just with that belief that we're going to see a little bit maybe more buying interest in the 10-year as we see the Fed meeting result, and therefore rates move lower as a direct result of that.
I think that's a perfect representation of a long position. I'm not that way. I actually think the stock market's going to do relatively well, and I think the curve's going to steepen because I think if the market believes that the Fed has tightened enough or too much, then the curve can steepen out a bit. So I'm doing one of those put flies. We've talked about these before. It's kind of a non-equal balance put fly. So it's buying the week one, expires on November 1st, the 2950-2900 put spread, which is a half point wide, and then selling the 128.75 put spread. So selling a quarter tick wide one. It risks 109 to make a potential 391. Expires November 1st. I did choose it because you also get unemployment. Thoughts?
You do. The unemployment thing is the wild card, though, to me. Yeah. That's really the one that's right, good or bad. And how does the market react to maybe a hotter than normal, say, employment picture, right? Which makes me think that would wash out any, say, Fed speak when it comes to maybe more easing or more dovishness that I think is in the cards. And therefore, that's why I wanted my trade to expire on the 30th.
When they ease, assuming they're going to ease, are they going to immediately give us signs that are saying that maybe it's the last one?
Well, I hope they don't, because that's been one of the problems in the past, is the Fed has talked maybe a little bit too much, Jim. They've been a little bit maybe too, if I could use the word, forecasty. So I think if the Fed keeps the line that they've had about data determining what they're going to do going forward, I believe that's what the market's looking for.
Thanks for joining us on Market Movers. I'm Jim Urio, where we are helping to make you a better trader.